Hi, my name is Cole Morris, and I'll be walking you through my final presentation for financial options trading around earnings reports. We're going to start with a brief overview of the stock market. Stocks are simply shares of ownership of the company that issues them. So, say for instance, Apple. When Apple issues a share of stock, all that is a fractional percentage ownership of Apple as a company. Now, companies frequently issue shares of stock to raise capital for their operations. If a company needs a large sum of money to buy new machinery or undertake new manufacturing processes, they will issue new shares of stock to get a large lump sum of money without taking a business loan. There's a little bit of math here to show you how it works out. If a company issues 100,000 shares of stock and I were to purchase 1,000 of them, I would own 1% of the company. And indeed, I would actually own 1% of that company. I would be able to vote at shareholder vote meetings. I would have input on the direction of the company. Granted, my vote would be very small. As profits increase, companies grow, and ownership becomes more valuable of that company. So stocks tend to grow in value over time for healthy or average companies. As long as the companies are not performing poorly, their stocks should increase in value or at least stay the same over time. How do stock prices change? According to the efficient market hypothesis, stock prices are a reflection of all the information currently available to investors. As such, stocks are naturally priced fairly and the mark cannot be beaten. This is at best a hypothesis and has been proven wrong in some capacities. The reason this is not entirely accurate 100% of the time is because investors are not always privy to all information surrounding a company's health. This is where things like insider trading come into play, where when someone has extra information, they know where a stock might be headed in the future and thus can trade accordingly and profit. So from this, we take away that information can create or destroy stock value. Bad press, company fines, news of decreasing profits are all things that reduce stock prices. Any bad news or any bad bit of information regarding a company will tend to reduce their stock price. Similarly, any good news coming out will tend to increase a company's stock price. One consistent, predictable event that frequently changes the price of a stock is a company's earnings report. And here's a brief overview of company earnings reports. Every publicly traded company is required to release an earnings report quarterly. These earnings reports are financial summaries of the company and their financial health. They contain different metrics such as net income for the quarter, total earnings for the quarter, total revenue, profits reinvested, earnings per share, etc. And every earnings report is required to follow industry standards so that they can be compared to other earnings reports. So for instance, I can take certain metrics off of the Apple earnings report and I can compare it to the Google earnings report, and I can use metrics like earnings per share to see, well, for all the shares outstanding for Apple, they earned more than for all the shares outstanding for Google. So by that metric, Apple performed better than Google in that quarter, if that's the metric that I'm looking at. One commonly predicted metric is earnings per share, EPS, and that is predicted ahead of time by big banks and professional expert investors. You'll see all sorts of things. Think Mad Money by Jim Cramer, where they'll say the predicted EPS for this company ahead of the earnings report is $1. Now, if the actual EPS reported by the company turns out to be 50 cents, that is a very negative surprise. Everyone thought it would be $1, turns out it was only 50 cents. That's bad news. Based on all the information available to investors at the time, everyone's thinking, okay, it should be about $1. Turns out it was 50 cents. We made way less money than everybody expected. Investors don't like that. Investors get nervous. They tend to sell those options, sell those stocks, and the stock price tends to decrease as a result of that. Similarly, if companies beat their expected earnings report and they perform far better than was expected, you will see stock prices rise after an earnings report. Now, stock options are a second type of financial instrument. They're called a derivative because they're derived from the price of the stock. A stock option holds its value based on the price of the underlying stock. This is a special type of financial instrument, and it's more of a bet on where the stock will go. You can buy and hold stock and you can sell stock later, or you can buy a bet on the stock price through a stock option. There are two types of stock options. They're call options and they're put options. Call options give the holder the right, but do not obligate the holder to buy shares at the set strike price. So if I were to buy a call option, I would say, okay, I want to buy a Apple call with this expiration date for $155. That would mean that if I were to exercise my call option, I could in the future buy Apple stock at $155 for however many shares that I purchased in call options. Similarly, for put options, if I purchase a put option, I could say, I want to be able to sell this many shares of Apple stock at this price at some point in the future. These options give the user the flexibility to say, okay, I might not do this, but in the event that it is profitable for me in the future, I'd like to reserve the right for myself to do this. If you hold this option, you are guaranteed the right at any time before expiry to be able to exercise this option and do as you initially bet. Options themselves can also gain or decrease in value and can be traded, bought or sold. So, anyone who is selling a financial option is then obligated to fulfill the option for the buyer. So if I sell someone an option, if I sell someone a call option, that gives them the right to buy a share of stock from me at the agreed upon price. If I sell somebody a put option, that gives the buyer, whoever I sold it to, the right to sell me a share of stock at the agreed upon price. Stock options are priced, as we said, based primarily on the underlying stock price. So a stock option of Apple's price is primarily derived from the Apple stock price. However, many other factors play into it. There's a number of factors, I think 7 or 8 of them. The main two are time to expiry and implied volatility. The first factor, time to expiry, is simply the number of days that the option has until it expires. Every time you buy an option, you specify the expiration date. So if I bought an option today, I would say, okay, I want my option to expire in a year. That gives me 1 whole year to potentially exercise my option. The longer I set as my expiration date, the more expensive the option is. This is because the option has more time to potentially reach its profit target. So it has a higher likelihood of becoming profitable at some point in time. Thus, it commands a higher price. The second factor is implied volatility. Implied volatility is a metric that gauges how likely an underlying stock is to move significantly in the near future. So, a higher implied volatility denotes that an underlying stock may jump rapidly in the near coming days, whereas a low IV says that same stock is more unlikely to jump significantly in the near coming days. So traders can profit from options in 2 ways. Options can be bought and then sold after they increase in value. For instance, if I buy a call option for $1 and the stock jumps wildly, that call option may become worth $2. So I can sell my option for $2 when I only paid $1 for it and I've made $1. Or if the stock price jumps a lot or decreases a lot in the correct scenario, I can exercise my option, and by doing so, it will be profitable for me to have exercised. For instance, if a trader buys a call option on Apple with a strike price of $150 and they pay $5 for the option, then Apple stock reaches $160 before the option is set to expire, that trader could profit immediately by exercising the option. Because the Apple stock is valued at $160 and the trader holds the right to buy it at $150, they can buy it at $150 immediately, sell it directly afterward for $160 and make a $10 profit. After you account for the $5 you initially paid to be able to do so, you've still profited $5. This brings me to the final part of my report, where I investigated the trading strategy that involves trading options around earnings reports. I chose to do so because earnings reports are a consistent, well-documented event that traders are very knowledgeable of ahead of time. You always know there's a calendar every single year of every single company's earnings report for each quarter, so I know tomorrow what exactly companies are releasing earnings report and when, and I know 3 weeks from now which companies are releasing their earnings reports and when. Right before an earnings report, implied volatility always increases drastically because the nature of an earnings report is that it holds new information. So the likelihood of a price jump increases because of the unknown information about to be released. As such, IV is historically high directly before an earnings report release and plummets directly after an earnings report release. Earnings report releases typically occur before or after market. So when the market closes at 4:30 or 4, you can say, all right, I'm going to release my earnings report at 4:05 p.m. And then at the next market open, the stock price will jump wildly as investors clamor to adjust their portfolios. Immediately after that news breaks, that implied volatility metric, one big chunk of the option pricing will plummet again, and the option price itself will start to return back to the normal baseline. So, if for an earnings report, the stock does not move significantly in price, if it's just a regular earnings report, the EPS was $1 predicted ahead of time, and it turned out to be $1.02, no big surprise, it's pretty much exactly as everyone expected, that IV will jump up right before and then drop drastically right afterward. And similarly, the option price will jump up before, as everyone thinks there will be new information, the stock may change. Everyone sees the stock does not change, and IV drops again. So, in theory, a trader can sell an option for a high price before a company releases its earnings report. I can look at Apple and I can say, okay, implied volatility typically is about 35 to 40% for Apple, but today, because they're releasing earnings after market, it is 90%. As such, options prices have jumped from $3 to $4.50. So I can go ahead and I can sell an option for more money than it is typically worth. It has an inflated price, so I generate $4.50 when I sell that option instead of $3. After the earnings report, if everything is as expected, there are no major surprises, Apple stock will stay at about the same level and IV will drop. After IV drops, that options price drops back down to about the $3 level where it typically hovers, and I can buy back that same option that I sold for $3. So I sold the option for $4.50, I can buy it back for $3, and I maintain the $1.50 credit that is the difference. After investigating over the last couple months, I have noticed a trend in what is called the VIX index, which is a general market uncertainty index. This index measures how volatile the entire market is at large. Since President Trump's inauguration, the financial sector has been very stable, and thus the VIX index has been low, and so many earnings reports have resulted in very little movement of the underlying stock price. And this would be a prime candidate or a prime time to implement this strategy where you see a lot of stock prices not reacting significantly to earnings reports, but you still do see that cyclical nature of spiking in IV, options prices inflating directly before earnings reports, and then deflating right after earnings reports as stocks stay stable, and traders can profit by implementing the right combinations of buys and sells of their stock options. Hope this has been informative, and thank you all for listening. Have a great rest of your summers and enjoy the upcoming semester. Thank you.